We have a massive internal beat today for Axogen, ticker AXGN. Let's just get straight into the Q2 2026 numbers because they are hot.
Yeah, really high.
Revenue hit $69.7 million. That's up 23.1% year over year. Adjusted EPS came in at 12 cents, though, they did report a GAAP net loss of 3 cents a share.
Right, right.
But here is the kicker. Full-year revenue guidance was aggressively raised to at least 24% growth. They're targeting a minimum of $279 million alongside gross margins of at least 73% and positive free cash flow.
Wow.
Yeah. Now, while the printed release today doesn't detail the wider analyst consensus or the immediate post-market stock reaction, make no mistake,
Oh.
putting out an aggressive guidance raise combined with 23% top-line growth, that serves as a very strong internal beat.
Absolutely. And, as retail investors looking at those numbers, our job today is to really look under the hood of that top line beat. Because the printed numbers are impressive, sure. But to see if this growth is actually sustainable for you, we have to unpack their segment performance, understand some critical margin shifts taking place, evaluate their commercial sales execution, and realistically assess the pipeline risks.
And we really need to start with that guidance raise right away, because bumping full-year guidance in the middle of Q2 is a bold move.
It is.
It's like a poker player confidently showing their hand before the final river card is even dealt. It begs the question, is this level of mid-year confidence actually justified? Or are they setting expectations so high that they risk a devastating miss in the second half of the year?
I'd say it's a highly calculated flex. When you dissect the underlying drivers, specifically the momentum within their individual medical segments, you see exactly why management felt comfortable putting those chips on the table early.
Right. They aren't just relying on macro tailwinds.
No, not at all. They have structural momentum in very specific surgical markets.
Which brings us to the first major hurdle in this report.
Yeah.
I'm calling it the margin paradox. We just established they have massive top-line growth, with revenue up over 23%.
Yeah.
But gross margin actually dropped 1.5 percentage points. It fell to 72.7%, down from 74.2% in Q2 of 2025.
Right.
And you see that reflected in the earnings, too. Adjusted EBITDA was $8.4 million, which is a 12.1% margin, down from 16.3% last year. So before we get to the why of the drop, can you just quickly level set for the retail investor on the EPS discrepancy? We mentioned a 12-cent adjusted profit, but a 3-cent GAAP net loss.
Right. Well, that is a crucial distinction. GAAP generally accepted accounting principles requires companies to include non-cash expenses. And for high-growth medtech companies, the biggest culprit there is stock-based compensation for employees, along with the amortization of some of their intangible assets.
Sure.
When we look at adjusted EBITDA and adjusted EPS, management strips those non-cash items out. That shows you the raw cash-generating power of their actual daily operations.
Okay, so from an operational cash flow perspective, they are profitable.
Yeah, even with that slight dip in gross margin.
Okay, but the margin itself still compressed by 1.5 points. My initial worry when I see that is inflation. Like, did their manufacturing costs suddenly spike, or are they heavily discounting the price of their nerve grafts just to win hospital contracts?
Neither, actually, and that is what makes this report so fascinating. The primary driver for this margin compression is a massive fundamental shift in their product mix.
Really?
Yeah. Specifically, the breast segment is accelerating at an incredible pace, growing over 50% year over year.
Wow.
50%. It is growing so fast, in fact, that their extremity segment, which covers things like traumatic hand injuries and has historically been their absolute bread and butter, represented less than 50% of total sales for the first time in the company's history.
Wait, less than half?
For the first time ever, yeah.
So they are essentially suffering from success. The fastest growing product just happens to be a lower margin item for them right now. It feels a bit like a retailer completely selling out of their trendiest item, but it's the item with the worst markup in the store.
I mean, that captures the math, sure, but it slightly misinterprets the broader strategy. A retailer can simply order different inventory next quarter. Axogen is trying to fundamentally change the standard of medical care.
Okay.
The breast reconstruction market, particularly something called neurotization during autologous flap procedures, is a relatively new frontier for them.
Okay, stop right there. Because neurotization during autologous flap procedures, that is some heavy medical jargon.
It is, yeah.
What does that actually look like for the patient on the operating table?
Fair point. So, in an autologous flap breast reconstruction, a surgeon takes tissue from the patient's own body, often the abdomen, and moves it to the chest to rebuild the breast after a mastectomy.
Okay, I follow.
When they move that tissue, the nerves are severed. Historically, the patient just lived with complete numbness in that area.
Wow, that's awful.
It is. Neurotization is the process of physically reconnecting the severed nerves in the chest to the nerves in the newly transplanted tissue.
Oh, I see.
Axogen provides the biological graft that acts as a bridge. It allows the patient's nerves to grow across the gap and actually restore physical sensation.
That is incredible.
Yeah.
They're basically giving patients their sense of touch back.
Exactly.
But why does that specific, miraculous procedure drag down their overall corporate margins?
Well, because it requires massive market development. Trauma surgeons fixing hands have used these grafts for years. It's routine. But breast reconstructive surgeons are adopting a completely new surgical algorithm.
Oh.
Axogen is investing heavily in training, specialized surgical kits, and market education. The specific mix of products bundled for these longer, complex breast procedures currently trails the margin profile of a straightforward trauma surgery.
So it costs them more upfront to establish the market.
Yeah, but getting that market share now is crucial because once these procedures become routine across hundreds of hospital systems, the volume scales up, manufacturing efficiencies kick in, and you typically see those margins optimize over time.
Which explains why management is still guiding for at least 73% gross margins for the full year. They expect to absorb this mix shift without just falling off a profitability cliff.
Look at it from a capital allocation perspective. Giving up 1.5 percentage points of gross margin today to secure a monopoly-like beachhead in a market growing over 50%. I mean, that is a strategic trade almost any management team would make.
Yeah, that makes sense. So we know the breast segment is the rocket ship driving this revenue beat. But how are they actually selling this on the ground? Because getting a surgeon to change how they've done a procedure for 20 years is notoriously difficult.
Oh, it's incredibly hard. Management strategy right now is heavily focused on what they call hypo accounts or high potential accounts.
High potential. Okay.
The data on this commercial execution is incredibly telling. 51% of their year-to-date growth came strictly from these hypo accounts.
More than half.
Yeah. So instead of having their sales reps knocking on every single hospital door across the country, they analyze the data. They identify the specific level 1 trauma centers and the specific reconstructive surgical suites that handle the highest volume of nerve injuries, and they embed their reps almost exclusively in those locations.
It feels very much like the Pareto principle in action. Focus heavily on the 20% of hospitals that perform 80% of the surgeries.
That's exactly it.
But I have a critical question about this strategy. Are they just squeezing more juice from the same oranges? Like, are they just getting more revenue out of surgeons who already love the product, or are they actually expanding the orchard and reaching new doctors?
Well, the metrics provided in this Q2 report prove they are executing on both fronts simultaneously.
Really? How so?
They noted a 20% productivity boost within these hypo accounts year over year. That is the deeper penetration. That means a surgeon who was previously doing 5 nerve repairs a month using Axogen products is now doing 6.
Okay, so they're adopting the product for a wider variety of injuries.
Yes, but alongside that, they added over 130 newly active surgeons year to date.
Oh, wow.
Yeah, bringing their total active hypo accounts to 690. That is the expansion. They are bringing net new practitioners into the ecosystem.
And when you look at the total addressable market, the TAM, the runway for that expansion is massive. I think they estimate their TAM at $5.6 billion.
Yeah.
But I want you to break that down for us, because it's not all just breast reconstruction, right?
No, not at all. Out of that $5.6 billion TAM, extremities, which is hand and arm trauma, still accounts for $2.9 billion.
Okay, so roughly half.
Yeah. Oral maxillofacial and head and neck surgeries make up $1.2 billion. Prostate is an emerging market at $754 million, and breast sits at $677 million. In their target markets, there are over 1.5 million peripheral nerve injuries requiring treatment every single year.
Every year.
Every single year. The demand is vast.
Knowing that the extremities TAM is roughly 4 times the size of the breast TAM, there's a fascinating point of leverage in their Salesforce infrastructure.
What's that?
The extremities segment currently have 126 sales reps. But the breast segment, the segment driving that explosive 50% year-over-year growth, only has 26 reps.
Right. I mean, let that efficiency sink in. A fraction of their total sales force is driving the most aggressive growth in the entire company. Management noted they are targeting about 30 reps for breast by the end of 2026, compared to around 130 for extremities.
It tells you the market demand for regaining sensation after breast reconstruction is so high, the product practically sells itself once the surgeon is trained.
Exactly. The surgeons are highly receptive because the patient outcomes are just so life-altering. It's an incredibly efficient use of commercial resources.
But here is where we need to introduce a healthy dose of skepticism for everyone. Excellent commercial execution and a highly motivated sales team only work if the product is backed by unassailable clinical data.
And payer coverage.
Right, ultimately payer coverage from insurance companies. Because if the insurance doesn't pay, the hospital doesn't buy it.
Yep.
So let's talk about the clinical moat protecting Axogen's market share from competitors. They just published the REPOSE study, which provides level 1 evidence for the Axogen nerve cap for symptomatic neuroma management. First, just break down the medical side for us. What is a symptomatic neuroma?
Sure. When a nerve is severed in an accident or during an amputation, the nerve doesn't just die. It actively tries to heal by reaching out to reconnect with the other side.
Okay.
But if it can't find the other end of the nerve, those sensitive nerve fibers tangle up into a microscopic ball of scar tissue.
Ouch.
Yeah. That ball is called a neuroma, and it is excruciatingly painful. Even a light touch can send shock waves of pain through the patient's body.
And the nerve cap physically blocks that from happening.
Right. It provides a biological barrier that caps the severed nerve ending. It stops the nerve from forming that painful tangle. What the REPOSE study did was prove scientifically that using this cap significantly reduces the patient's pain burden and their reliance on pain medication.
But you mentioned this was level 1 evidence. Now, in biotech, we hear companies bragging about trial phases all the time.
Yeah.
Why does level 1 evidence matter so much in this specific context?
Because in the medical community, level 1 is the absolute gold standard. It requires a prospective, randomized, controlled clinical trial. Now, think about how difficult that is in surgery. In a pharma trial, you give 1,000 people a pill and 1,000 people a sugar pill, right?
Right. Very straightforward.
It's highly controlled. But in surgery, every single patient's injury is structurally unique. A nerve severed by a table saw is completely different from a nerve damaged by a dog bite.
Oh, I see what you mean.
To design a randomized trial that successfully accounts for all those chaotic surgical variables and still proves statistically that your nerve cap is superior, that takes years and millions of dollars. Having that level 1 publication is a massive barrier to entry. If a competitor wants to launch a copycat nerve cap tomorrow, hospital purchasing committees will look at them and say, well, where is your level 1 data?
It becomes the ultimate trump card for the Axogen sales rep.
Precisely.
And they're taking that exact same aggressive approach with their core nerve graft product. They just activated the first site for the Nerve Restore study. This one compares their advanced nerve graft head-to-head against sural nerve autografts. Let's clarify the terminology. Their product, the allograft, is human donor tissue that has been processed and sterilized, right? Off the shelf.
Correct.
And the autograft is the old school method.
Yes. For decades, the gold standard for fixing a severe nerve gap in a patient's hand was an autograft. The surgeon literally cuts open the back of the patient's calf, harvests the sural nerve from their leg, and transplants it into their hand.
That sounds brutal. So you are creating a second surgical wound, and the patient loses feeling in their leg just to fix their hand.
Exactly. And Axogen is attempting to prove mathematically in the RESTORE study that using their off-the-shelf allograft is actually superior in patient outcomes to harvesting the patient's own leg nerve.
And if they prove that,
If they win that argument in a level 1 study, it fundamentally rewrites the global medical algorithm for nerve repair.
and that clinical data is the battering ram they use for insurance coverage. Right now, commercial payer coverage for the advanced graft is at 86% of covered U.S. lives. However, management noted they are still awaiting a critical coverage decision from Aetna. Their stage goal is to achieve near universal U.S. coverage by the second half of 2028.
Which is the timeline every retail investor needs to circle in their notes. 2028 is the inflection point where the reimbursement friction effectively disappears. When a surgeon knows they don't have to fight with insurance to get the product paid for, adoption skyrockets.
Okay, so they are building a moat with data, but they are also trying to build a moat through innovation outside of just the physical grafts.
Yes, they are.
Let's look at their M&A activity. During the quarter, Axogen acquired a minority stake in a company called Trace Biosciences, securing a limited right of first refusal. Now, Trace is developing real-time intraoperative nerve visualization technology. How does this actually work?
Well, the current prototype technology involves injecting a specialized fluorescent imaging agent into the patient. This agent specifically binds to nerve tissue. So when the surgeon looks through a specialized camera system during the operation, the nerves literally glow on the monitor, highlighting them against the surrounding muscle and fat.
That is incredible science.
It really is.
But from a business strategy perspective, I do have to push back a little. Axogen's core business is selling grafts to repair severed nerves. Investing in visualization tech to help surgeons avoid cutting nerves feels somewhat counterintuitive. It's like a gold miner spending capital to buy the company that makes metal detectors for hobbyists. Is this just a distraction from their core graft business?
If they were only focused on trauma, it might be a distraction. But think about where their massive growth is coming from. The breast segment and the emerging prostate segment.
Right.
In a robotic-assisted radical prostatectomy, the surgeon is trying to remove a cancerous prostate. The biggest risk is accidentally nicking the microscopic web-like nerves surrounding the prostate that control urinary and sexual function. Currently, visualizing those nerves is incredibly difficult.
So if Axogen can offer a hospital not just the repair graft, but the actual visualization technology to map those nerves in real time,
Yes.
they own the entire continuum of nerve care in that operating room.
Exactly. It's not a distraction at all. It's an ecosystem play. If the surgeon is already using Axogen's fluorescent dye to map the nerves, and they unfortunately still have to cut one to remove the cancer, they are already firmly inside the Axogen ecosystem.
Wow, right.
The surgeon simply pulls the Axogen repair graft off the shelf to fix it. It makes their core product incredibly sticky. It builds a defensive wall around the operating table that competitors just can't penetrate with a generic graft.
Okay, let's pull all of this together. The 50% growth in breast, the level 1 clinical moat, the shift into visualization tech, and bring it all back to the balance sheet.
No.
Because none of these ambitious plans matter if they run out of cash.
Right, absolutely.
But Axogen appears to be in a highly secure position to execute this strategy over the next few years.
Oh, without a doubt. For a growth stage medtech company, their balance sheet is remarkably clean.
They boast $113.4 million in cash equivalents, and investments. But most importantly, they have zero debt obligations. None.
That is huge.
And as we mentioned at the top, they are projecting positive free cash flow for the full year 2026.
We really have to view that in the context of the current macroeconomic environment, because for the last few years, the cost of capital has been a massive headwind for healthcare and biotech companies. High interest rates have crushed companies that rely on debt to fund their clinical trials.
Right.
Having $113 million in the bank and absolutely no debt service to pay is a massive strategic advantage. It means they fully fund their own destiny. They can comfortably afford the temporary gross margin hit to build out the breast segment. They can afford to fund massive multi-year level 1 clinical trials like Restore without diluting shareholders.
It really takes the existential financial risk off the table for you, the retail investor. You don't have to wake up tomorrow worrying about a toxic debt offering.
You don't.
No.
But I do want to leave you with a final thought to ponder today. A strategic shift that wasn't explicitly highlighted in the financial tables, but is absolutely critical to the company's long-term future.
Oh, what's that?
Well, we spent a lot of time today exploring their explosive 50% growth in breast reconstruction. We touched on their prostate segment development, where they've now completed over 100 procedures and are expecting a meaningful clinical update by the end of 2026.
Right, and both of which are highly scheduled elective operations.
Precisely. For the first decade of its existence, Axogen was a trauma company.
Sure.
Someone puts their hand through a plate glass window, or there's a terrible industrial accident, and the surgeon uses Axogen to fix the nerve. Trauma is wildly unpredictable.
Right, you can't model that.
But breast reconstruction and prostatectomies are scheduled weeks in advance. Axogen is aggressively pivoting from unpredictable trauma towards scheduled elective procedures.
It's the difference between running an emergency roadside towing company versus a scheduled corporate fleet maintenance business. I mean, one is chaotic, the other generates highly predictable recurring revenue.
Exactly. So if this growth trend continues, driven by that massive breast segment adoption, will traumatic nerve repair, the absolute historical foundation of their $5.6 billion TAM, eventually become a mere afterthought to their high-growth elective businesses.
Wow. Yeah?
And if they do successfully transition from a trauma company to an elective surgery company, what does that mean for their long-term identity? Because Wall Street applies very different, often much higher valuation multiples to companies with highly predictable elective revenue streams.
That structural shift in their identity and how the market chooses to value it is the exact narrative to keep an eye on as we watch the back half of 2026 unfold.
Definitely.
Thank you for joining us for this deep dive into Axogen's Q2 earnings report. Make sure to follow the show for daily, no-fluff earnings coverage just like this right here on your feed. We'll see you on the next deep dive.